Welcome, everyone, and thank you for joining us today. As many of our audience will be aware, at Pangea-Risk, we are all very excited to have launched our expanded Asia analysis coverage on the Insight Country Risk Forecasting platform. And our timing could not be more relevant. Asia's importance in today's global economy cannot be overstated, underpinned by fast economic growth, resilient trade, and diversified investment models. The region is actively seeking deeper integration to reduce exposure to external shocks. It is unsurprising then that our webinar today aims to delve into the region, looking at how Asia's resource security challenges sit at the intersection of global energy supply, critical mineral demand, and outward investment trends. Today, we'll connect Asia's vulnerabilities in oil and mineral supply chains with its expanding role in Africa's investment landscape, highlighting Asia's growing strategic importance. Now, to tackle these issues, I am joined by our Head of Risk Forecasting, Bilal Bislioni, Head of Asia, Saif Islam, and our Senior Africa Analyst, Zainab Quessa. Welcome to you all. Now, to begin, I wanted to start with a 30,000-foot view, really looking to situate the Asian market within the broader geopolitical context, and specifically what Asia's oil dependency can tell us about broader supply chain risks to better understand some of the recent Asia-led activity we're seeing on the global stage. So Bilal, within your role for risk forecasting, part of your remit is to regularly analyze the impact of global dynamics on specific markets. So I'm going to start with you. What are Asian economies, so I beg your pardon, rather, why are Asian economies so vulnerable to disruptions in Middle Eastern oil supply?
Thanks so much, Gabby. So Asia's vulnerabilities really begin with its geography, one, and secondly, its dependence. So as many of us would know, more than 70% of crude oil flows through the Strait of Hormuz, and a very important choke point in the Middle East. And this choke point is where majority of the crude oil it goes to Asian markets, particularly China, India, Japan, and South Korea. And these economies rely on Middle Eastern suppliers because of volume, but also because of crude grade compatibility with their refineries. So unlike the United States, which has diversified supply chains and increased domestic production, Asia remains quite structurally dependent on the Gulf. So when the region faces military escalation or any forms of tension, the resulting price surges and the freight prices also spike, immediately hitting Asian importers. And their limited ability to diversify quickly, owing to refinery configurations, long-term contracts that a lot of these importers have, and also limited access to alternative suppliers, magnifies this overall vulnerability.
Then how do Iranian threats to the Strait of Hormuz or Israeli strikes on Iranian energy assets, for example, jointly contribute to this vulnerability?
Yes, so the risk here is dual in nature. So on one hand, Israeli strikes on Iranian infrastructure that would directly reduce Iranian export capacity, and which could create immediate shortfalls, right? But on the other hand, Iran's retaliatory threats to close or disrupt the Strait of Hormuz generates this uncertainty over the safe passage of Gulf oil tankers through the choke point. So this combined effect is two front vulnerabilities. So first, supply loss from Iranian production, which is quite damaging, but the threat to transit the Strait of Hormuz amplifies Asia's exposure. So, and we've seen this in the last escalations between Iran and Israel. So even without an actual closure, the mere prospect of mines, drones, or even naval harassment dries up insurance premiums, shipping rates, and spot market prices. So production capacity would reduce onshore and maritime transit, which again threatens this dynamic and also translates into compounded vulnerabilities for Asian economies.
Okay, so hypothetically, if we do see that level of disruption in the Hormuz Strait, can Asia rely on alternatives, perhaps Saudi Arabia's East-West pipeline, for example, or even ports along the Gulf of Aden?
Yes, I think this is a very important dynamic, and we've seen in the last episode of escalations between the two, oil markets didn't really shift that much. And this was precisely for this reason. Saudi Arabia quickly used this east-west archaic transit route, bypassing the Strait of Hormuz and using the Red Sea. Also, the United Arab Emirates used the Fujairah outlet onto the Gulf of Oman, bypassing the Strait of Hormuz. But this is not a sustainable model. One, because Iran, Qatar, Kuwait, Iraq, the remainder of the Gulf's oil producers do not have the same means. So, in the period of extended conflict, the alternatives so far will not be enough to soften the blow on a long term.
Thank you. So definitely something to watch a little bit more closely. Now, just to sort of move away from the Middle East dependency there, just as Asia is, as you mentioned, dependent on oil from the Gulf, I think it also faces a parallel challenge around critical minerals. The geopolitics here may differ, so perhaps the stakes are slightly different. Now, Saif, could you perhaps walk us through how critical minerals mirror the story of dependence on the one hand and then strategic maneuvering on the other? And perhaps specifically, how effective are the US and ally-led efforts likely to be in establishing a rare earth supply chain that reduces dependence on China, for example?
Sure. I mean, I think these efforts are making incremental progress, but overcoming China's dominance will be extremely challenging. Right now, China currently controls about 70% of global rare earth production and 90% of processing. And this dominance reflects decades of state support, investments abroad, and tolerance of environmental costs perhaps avoided elsewhere. Right now, the US and other countries are trying to catch up by seeing domestic production, financing processing facilities, and investing in new technologies. The US has also introduced subsidies and purchase guarantees to make domestic production viable. But such measures can't really be replicated everywhere. And China certainly retains the ability to keep prices low to deter competitors. So essentially, Western initiatives may help diversify supply and build strategic buffers, but reducing dependence on China will require a really long and complex process of reconstructing the full supply chain from mining to processing to manufacturing.
So, I mean, with that in mind, which Asian countries, and perhaps I appreciate possibly producing relatively little today, but which markets actually do hold substantial reserves, and how are they positioning themselves to capitalize on this rising global demand?
Yeah, several Asian countries are sitting on substantial but largely undeveloped rare earth reserves like India, Vietnam, Indonesia, and Kazakhstan. India, for example, has launched initiatives to expand domestic production while signing bilateral agreements with several countries with the aim of reducing its reliance on imports from China. So we are seeing the rollout of national strategies across the region, such as government-led industrial development programs, improved mining laws, and new investment incentives. There's also a clear push to build processing capacity, secure technology transfers, and move further down the value chain into manufacturing. So the common thread here is that these countries don't just want to remain mere suppliers of raw materials. They want to develop complete rare earth ecosystems. But as noted earlier, this is easier said than done. And China obviously got to the position it's in now after decades of investment and trial and error.
I want to touch on what you mentioned there around being easier said than done. I mean, could you maybe walk us through a specific case study where things are likely to be more complicated? So I know in Myanmar, for example, we see rebel groups dominate much of the territory where sort of rare earth opportunities lie. What are the implications for regional supply chains with a case such as that?
Yeah, Myanmar is actually a really good example of how fragile rare earth supply chains can be. The country is the world's third largest producer of rare earths after China and the US. But control of many of these mines has shifted to rebel groups such as the Kachin Independence Army or the KIA, which pushed the Myanmar military out of key mining areas. And China imports feedstock from Myanmar for processing at home and has actually urged the KIA to reach a ceasefire agreement with the Myanmar military. But the KIA has rejected these calls and has even set new conditions and taxes on rare earth exports to China. And these issues have actually prompted China to intensify rare earth development in Shan State with the help of a more China-friendly rebel group. On the other hand, India is reportedly exploring a rare earth deal with the KIA. So in essence, the instability in Myanmar injects a degree of uncertainty into rare earth supply chains as these mines are entangled in conflict, sanctions, and competing geopolitical interests.
Well, thank you for that. Zainab, I want to bring you in here. I mean, given your focus on Africa, and I think the widespread recognition of the continent's significant market opportunity due to its growing consumer base, for example, I think potential innovation, future labor force, the list goes on. Can you take us through how Asian countries are engaging in Africa's investment landscape? I mean, specifically, which Asian countries are really leading in FDI flows into Africa, for example?
Thanks, Gabby, and good afternoon to everyone listening. So, China is definitely the clear leader when it comes to FDI in Africa. And Asian investment in general has really been picking up in recent years. And this is largely due to the growth prospects that Africa has to offer. So Africa is the fastest growing region after Asia, and investors see that its young urbanizing population could be an opportunity for a vast growing consumer base and also a future workforce. So platforms like China's FOCAC and Japan's TCAD all underscore how Asian investors are starting to really pick up engagement with Africa. So in terms of FDI, beyond China, Singapore has emerged as a top 10 investor in Africa with about $2 billion worth of FDI stock. And this is led by companies that are invested in consumer goods, specifically in West Africa, like Olam and Tolaram. And they have operations in agribusiness and consumer goods. And then we've got India that has an FDI of about $13 billion. This is concentrated in telecommunications, energy, and pharmaceuticals. And then Japan is a growing player as well. Although a lot smaller, still significant. Japan's 9 billion FDI stock is mainly invested in South Africa. But with the TCAD last month, we see that this is a focus area that the government wants to grow in the coming years.
Thank you. I think one thing we've seen over recent years has been the massive investment in infrastructure, not least off the back of, China and the Belt and Road Initiative. Maybe you can speak a little bit to that beyond China and the Belt and Road Initiative, which gets a lot of headlines. Who else is playing a role specifically on the infrastructure side of investments?
Yes, so Japan is actually one of them, which I just mentioned now. And although historically they may not have that much exposure in African infrastructure like what China does, but at last month's DCAD that they hosted, the government actually pledged $5.5 billion worth in loans. What they were going to do is they're going to channel these loans through the Africa Development Bank. So it will go towards infrastructures that's aimed at sustainability. And this will really increase Japan's engagement on the continent. Japan is specifically also pledged investment in the Nacala corridor, which will link Mozambique's coast to the inland countries of Zambia and Malawi. And of course, this would act as an important export corridor. Getting the minerals from the African inland areas off to the coast for exports. And then there's also some smaller players like India and Indonesia and Singapore as well. We see that Trafigura plays an important role in the Lobito corridor by running those operations. And Lobito corridor is another important export route for copper and cobalt that's coming from the DRC and Zambia to get to the coast more quickly and more efficiently.
Yeah. I think one thing that we look at specifically from a political and country risk side at Pangea-Risk is with African investments, there can be a heightened concern around political risk dynamics, for example. But just sort of flip the script a little bit and look at the opportunity side. How do Asian investors really approach risk mitigation as they expand across African markets?
Yeah, and this is something quite important, Gabby, because I think a lot of the time when investors hear about the risks that are on the continent, and then also having an extra layer of negative reporting about the continent, it then almost results in investors rather stepping away instead of engaging and seeing how they can still make those investments, but shield themselves from the risks. So lately, we've seen more daring investors become more sophisticated in their risk mitigation strategies, and also implementing risk mitigation strategies that are already implemented elsewhere. Because at the end of the day, it's not that that there isn't options to shield the investment. It's just that it's not often done in Africa. So political risk insurance is widely used, given that there have been cases about nationalization and expropriation on the continent. Investors are now seeking to shield themselves from these risks. So, for example, Japan Sumitomo bought a stake in Safaricom Ethiopia. And what they've done is that this is covered by a TD and also NEXI, so Japan's own export credit agency. Then other export credit agencies, excuse me, such as China's Sinosure, Korean Exim Bank, they all also play an important role in underwriting these assets so that investors aren't forced to stay away, but they can take the risk, and also encourage further investment in jurisdictions that are perceived as higher risk. Then there's also blended finance. A blended finance could be an example of what Japan is doing with the Africa Development Bank. So Japan isn't taking all the risk of the $5.5 billion. It's doing this in cooperation with the Africa Development Bank. And then another strategy, which is perhaps more of a traditional one, is to form partnerships with local players. And the India's Bharti Airtel, who is involved in some African markets, have done this through the telecommunications expansion. So there are options. It's just a matter of making them available, making it known that there are ways to shield investments against these risks.
Well, thank you. And I think that's a good way to end off this session. Perhaps just to summarize, I think it's fair to say that Asia's story is definitely one of managing dependence, specifically oil and critical minerals, while at the same time building outward influence through investment, as Zainab has outlined there, particularly in Africa. So certainly themes around vulnerability and resilience, competition and increasing cooperation as well. But then to that final point, risk and opportunity, with Africa really representing both a challenge, but perhaps a solution as well. Well, thank you all to the speakers today. I really, really enjoyed the discussion and really look forward to continuing this important conversation over Asia's strategic role in resource as well as investment flows. So thank you so much for your time.
Thank you, Gabby.
Thank you all.
Thank you.
Thank you.
Bye.